The Fed and macro has been widely discussed in crypto recently, especially after the money printer stopped going and the Fed started its monetary tightening policy after the pandemic. Today, we will discuss the Federal Reserve, aka the Fed. What is it, what does it do, and how does the Fed affect crypto? First, let's take a quick history lesson. In the years leading up to 1907, loose monetary policy in the US made money and credit easy to be obtained, leading to excessive speculative investments. Well, shit hit the fan when these risky investments failed in October 1907, which triggered widespread bank runs throughout the US as the public lost confidence in the banking industry. This eventually became one of the largest, albeit short-lived financial crises known today as the Panic of 1907. Without a central bank, top bankers, notably JP Morgan, stepped in and bailed out surviving Wall Street banks and other institutions with money out of their own pockets, effectively acting as the lenders of last resort to the US economy. In response to the crisis, bankers and US government officials came together in 1910 to form the National Monetary Commission to research and design the framework for the Federal Reserve. In 1913, the Federal Reserve was created, initially with the goal to bail out troubled banks. However, it has evolved over the decades to provide more government oversight on banks and financial institutions with the intention of creating a more stable financial system. So, what is the Federal Reserve and what does it do? The Federal Reserve, or the Fed for short, is the central bank of the United States and is responsible for providing financial services to financial institutions, supervising commercial banks, and contributing to monetary policy. For the purposes of this video, we will be focusing on the Federal Reserve's role in monetary policy. The US Congress assigned the Fed to conduct the nation's monetary policy to support the goals of maximum employment and stable prices. This is commonly referred to as the Fed's dual mandate. Price stability essentially means the Fed is targeting a 2% inflation rate over the medium term to provide confidence for the people to spend and invest. On the other hand, maximum employment means achieving the highest amount of employment the economy can sustainably support. This means that the Fed must balance these two objectives, ensuring that there are as many jobs as possible for everyone while keeping inflation low. The Fed tries to fulfill its dual mandate through monetary policy, which, simply put, is a set of tools that the Fed uses to manage the supply of money in the economy. The branch of the Fed which is responsible for setting monetary policy is the Federal Open Market Committee, aka the FOMC, whose meetings and rate hike decisions are the ones you've probably been hearing about so much over the past year and a half. First, the FOMC reviews economic data during regularly scheduled meetings and forecasts the growth of the economy. Based on how the economy is doing, one of the main things that the FOMC decides on is the new target for the federal funds rate, which is the interest rate banks charge each other on overnight loans. Changes made to the Fed funds rate have effects that eventually trickle down to the economy. So these tools are more like turning the temperature knobs of an oven rather than flipping switches on or off. For example, if inflation is running high and the Fed thinks that the economy might be overheated, the Fed could start raising the federal funds rate, commonly known as a rate hike, which leads to higher interest rates on credit cards, loans, and mortgages. Higher interest rates lead to higher costs of borrowing, which causes businesses and consumers to spend less. Lower spending eventually leads to falling prices and lower employment as businesses make less money. Now that we know in simple terms how the Fed is able to move markets, let's look at how the crypto market has responded to the Fed's policies. The pandemic saw an unprecedented increase to the money supply with an estimated $6 trillion injected into the economy. For everyone that was around during that time, I'm sure you remember how Bitcoin rallied to new all-time highs along with the rest of the crypto market. However, due to the massive increase of liquidity in the economy, combined with supply chain disruptions caused by COVID restrictions, inflation ran hot as the price of goods and services skyrocketed in 2021. In response to rapidly rising inflation at the start of 2022, the Fed started raising the Fed funds rate and has done this 10 times since March 16th last year, which coincided with when the crypto market fell into a bear market. This makes sense, as explained earlier. Higher interest rates makes money more expensive because borrowing is more costly. When less money is making its way into the economy, investors tend to be more careful and are less likely to pour money into risky assets such as tech stocks and, you guessed it, crypto. Inversely, when interest rates are low and borrowing becomes cheaper, it encourages businesses and consumers to borrow and spend more. With more money in the economy and more people being employed, more money tends to find itself flowing into riskier assets. Well, this really only scratches the surface of this topic.
There's so much more.
Setting the Fed funds rate is just one of the monetary policy tools that the Fed wields, but we hope that this video has helped you understand what the Fed is, what they do, and how they can influence the crypto market. If you hear about yet another rate hike from the FOMC in the near future, well then, you should be able to understand better what it means. Speaking of how the crypto markets have been doing lately with the rate hikes, you can watch a video where we compared all the Bitcoin bear markets right here.